While retail is panicking at extreme fear readings of 10 times, the whales are quietly doing the opposite. F2 Pool's founder just pulled $67.5 million in ETH off Binance. Lookonchain tracked 23M plus in fresh whale buys this week alone. 7 million ETH has left exchanges since 2023. That's $13.7 billion that's not available to sell. Today, we're connecting the dots. What do the whales know that you don't? This is the AIA podcast. Let's get into it.
The divergence we're seeing right now between what the public feels and, well, what the data actually shows it's truly historic. It's great to be here to unpack it all.
Yeah, welcome to our latest deep dive. You and I are sitting down today with a massive stack of sources. We've got recent market analytics, on-chain data reports, and some major institutional press releases from right now, March 2026.
Lots to go through.
Exactly. Our mission for you listening today is to figure out why the smart money is behaving completely differently from the retail crowd. I'm going to lay out some genuinely surprising data that I found digging through the network ledgers, and I'm relying on you to challenge the obvious assumptions, ask the hard questions, and connect the macro dots so we can see the full picture.
That is the goal. We have to look past the surface noise of the daily price tickers because, the underlying architecture of global finance is shifting right under our feet.
Okay, so let's unpack this current market sentiment first, because the psychology out there is just bleak. Right now, the crypto fear and greed index is sitting at a 10. Some metrics in our sources even have it dropping as low as 5 out of 100.
Which is incredibly low.
Right. To put that in perspective for you, that is absolute extreme fear. We're talking about historic lows that we really haven't seen since the FTX collapse back in November 2022 or, the global market panic of March 2020.
When everyone thought the sky was falling.
When everyone thought the sky was falling. Yeah, the retail crowd is utterly terrified and heading for the exits. But I was looking at the on-chain data last night, and the actual blockchain ledger tells a completely contradictory story.
Which completely flips the narrative. Yeah. The sentiment is screaming at retail to sell everything, but the immutable ledger is showing massive, coordinated accumulation by the largest players in the space.
Let me give you a specific example from the reports. Look at Chun Wang, the founder of F2 Pool. He is a billionaire-level player, someone with deep technical knowledge of the space.
He's not just a casual trader.
Not at all. He just moved $67.5 million in Ethereum completely off Binance and into personal wallets. And it's not an isolated incident. Lookonchain has been tracking a flurry of activity this past week alone. We are seeing over $23 million in fresh ETH brought and transferred by whales in coordinated timing.
Coordinated?
Yeah, one specific address starting with 0YFB7 quietly accumulated over 70,000 ETH in just a matter of days. That is well over $200 million.
What's fascinating here is the contradiction in behavior. If the market is supposedly crashing and sentiment is at absolute rock bottom, we have to ask why these billionaires are pulling assets into self-custody or deploying them into yield-bearing DeFi protocols like AAVE.
Right, because that takes effort.
Exactly. For those who might be newer to the mechanics of decentralized finance, AAVE acts like a decentralized lending market. You provide liquidity and you earn an interest rate. If you are truly panicked about a systemic market collapse, you hide your assets in cold storage offline hardware wallets that act like a digital mattress. You definitely don't actively deploy tens of millions of dollars into lending markets.
They aren't running for the exits at all. They're setting up shop for the long haul. Let me clarify the mechanics of what's happening on the network itself, because this specific data point made me do a double take. There is a queue to become a validator on the Ethereum network.
To earn the staking yield.
Exactly. Essentially, you lock up your ETH to help secure the blockchain, and in return, the network pays you a yield. Right now, there are 3.47 million ETH waiting in a digital line to enter that staking contract. Do you know how many are waiting to exit?
Wait, compared to nearly 3.5 million entering, the exit queue must be practically non-existent.
There are only 96 waiting to exit.
96,000.
No, not 96,000. Just 96 ETH. That is a 36,000x difference between people wanting to lock their assets up for the long term versus those wanting to pull them out.
That is staggering.
Furthermore, the network activity itself is waking up. We hit 735,448 active addresses as of March 2nd, showing life returning after months of stagnation. And if you zoom out even further, 7 million ETH has completely vanished from centralized exchanges since 2023. Exchange reserves have plummeted to multi-year lows.
So, what this means for you, the listener, is a classic mismatch between perception and reality. Retail traders are selling at a loss because they only look at the red price charts and scary headlines. But if you look at the underlying network, These whales are deliberately causing a supply squeeze.
Because they're buying it all up.
Yes, when supply leaves exchanges, it means those holders aren't planning to sell anytime soon. They are absorbing the panic selling, pulling those coins off the open market and locking them up. They are operating on a multi-year horizon while retail is operating on a multi-day horizon.
But here's where it gets really interesting and honestly a bit confusing if you only read the financial papers. We just talked about this massive supply squeeze and whales buying everything up, but our sources also highlight a glaring contradiction.
The ETFs.
Right. Ethereum exchange-traded funds, the ETFs, have seen $2.76 billion in net outflows over the last 4 months.
This raises an important question. If whales are buying hand over fist and the available supply on exchanges shrinking to multi-year lows, how do we explain billions of dollars bleeding out of the exchange-traded funds? Aren't institutions leaving?
It certainly paints that picture on the surface. But let's break down the mechanics using an analogy. Think of an ETF like a rented hotel room. It's highly convenient, someone else makes the bed, you don't have to worry about maintenance, and it's great for a short stay.
But you don't own it.
Precisely. You don't actually own the property, you pay a daily fee for the service, and you certainly can't renovate it or rent it out yourself. On-chain wallets are like buying the actual real estate. Investors aren't fleeing the asset, they're just checking out of the hotel. They are rotating their capital.
Making it work for them.
Sophisticated players realize they don't want to pay a management fee to a Wall Street issuer when they can hold the underlying asset themselves. They are moving their coins out of these restrictive ETFs and moving them directly into staking, cold storage, and DeFi protocols where they can actually earn a 3 to 4% yield themselves. Over 30% of all circulating ETH is now staked. It's locked up earning interest, not sitting stagnant in an ETF wrapper.
That capital rotation completely changes the equation. The money isn't leaving the ecosystem, it's migrating to a more productive layer of the infrastructure where it can be put to work.
And we know institutional money is still coming in. They're just being highly selective about how and where. Just this week, we saw massive Bitcoin ETF inflows, $506 million in a single day.
$500 million in a day.
Yeah. But even more telling than daily ETF flows is who is actually allocating this capital now. We're seeing ultra-conservative university endowments, places like Harvard and Brown, beginning to make structural long-term allocations to these assets. Endowments operate on decades-long timelines. They have structurally different risk profiles than retail day traders. This isn't a speculative trade for them. This is generational wealth management.
When you synthesize that, the massive ETF outflows we're seeing are essentially an illusion of weakness. The headline says billions leaving, but the blockchain shows that the broader holder base, the people taking direct custody and staking, is actually overwhelming the sell pressure. The institutional base is solidifying.
Which is a perfect bridge into what is happening in the traditional finance sector, or TradFi, because the infrastructure moves happening there right now are staggering. I was reading through the March 2026 institutional reports, and 12 of Europe's biggest banks have officially formed a consortium called Qivalis.
12 of them.
Heavyweights: ING, UniCredit, BNP Paribas, CaixaBank, BBVA, Danske Bank, DZ Bank, Sevabe, KBC, and Raiffeisen. Their stated goal is to build a micro-regulated euro-pegged stablecoin set to launch in the second half of this year. And they're already in talks with major crypto exchanges for day-one liquidity. For those who haven't waded through European financial legislation, MiCA is the markets in crypto assets regulation. It basically provides a crystal-clear legal rulebook for operating in Europe.
I have to push back a little on the significance of bank consortiums, though. Banks have experimented with blockchain for over a decade. We've seen private ledgers, pilot programs that come and go, press releases that lead to nothing, and consortiums that quietly disband after 2 years. What makes this 2026 infrastructure stack any different from the sandbox experiments of 2018?
Because the capital flowing into the underlying plumbing proves this isn't an experiment anymore, it's a structural takeover. Look at the private equity space. We just saw a £185.7 million takeover of Augmentum fintech by the Norwegian buyout group Verdane.
And their shares jumped on that news.
Jumped 25%. Private equity firms like Verdane do not buy out infrastructure if it's still in the experimental phase. They buy it when the technology is mature enough to generate consistent, scalable revenue. Or look at Ripple. They just hit a $40 billion valuation following their integration with the DTCC.
The DTCC, the Depository Trust and Clearing Corporation. For anyone outside of institutional clearing, they are the absolute central nervous system of the U.S. financial markets. They process quadrillions of dollars in securities transactions.
Quadrillions, with a Q. And they aren't just testing the waters on a private server anymore. The integration connects Ripple's prime brokerage directly to U.S. clearing rails, meaning institutional crypto trades are now settling through traditional infrastructure.
That's a massive shift.
The legacy financial system is systematically moving on to distributed ledgers. We're also seeing tokenized treasuries, big U.S. government debt put on a blockchain surge past $5 billion in market cap earlier this year, and our latest sources show it's now over $8 billion. JP Morgan just issued $50 million in commercial paper directly on the Solana blockchain. Goldman Sachs launched tokenized money market funds.
If we connect this to the bigger picture, the narrative shift is profound. When 12 of Europe's biggest banks are building a stablecoin and the DTCC is clearing trades, crypto infrastructure isn't speculative tech anymore. It is literally becoming the plumbing for global banking. The infrastructure stack we are seeing in 2026 includes qualified custodians, prime brokerage, DeFi to TradFi bridges, and seamless tax and accounting integration.
The boring, necessary stuff.
Exactly. These banks aren't building a stablecoin to trade internet jokes. They are building it to handle cross-border trade settlements, corporate payrolls, and real-time clearing. The full institutional stack is finally here.
And that upgrade isn't just happening in banking isolation. It's colliding with another massive technological shift. Let's talk about the convergence of artificial intelligence and this new financial infrastructure. I was looking at recent venture funding, and a company called RenoFi just closed a $22 million Series B funding round. Now, a Series B isn't seed money for an idea. It's capital meant to scale a proven business model.
Who led the round?
It was led by Fifth Wall alongside Progressive Insurance. RenoFi's entire model uses AI for renovation financing. We also have Gradient AI expanding heavily into AI-powered insurance and financial analysis.
We hear AI and fintech thrown around as buzzwords constantly in startup pitch decks. It usually just means a slightly better customer service chatbot or a faster high-frequency trading algorithm. Is there actually real utility here that justifies tens of millions of venture capital?
It's going way beyond trading bots. The mechanics here are about fundamental infrastructure convergence. Real institutional money, that $22 million for RenoFi, the $186 million for Augmentum, and the billions flowing into crypto plumbing, is backing companies that blend AI and financial services to completely reshape lending, underwriting, and risk assessment.
How does that look in practice?
Think about the old way of getting a renovation loan. It involves piles of paperwork, manual appraisals, and weeks of waiting for a human loan officer to underwrite the risk. Now, AI models are analyzing massive data sets, priority values, contractor histories, alternative credit data to model that risk instantly.
This brings up a critical point about positioning, because this is exactly the kind of infrastructure convergence that AI analysis, or AIA, is building for. It's not about using an AI to predict if a token will go up 5% tomorrow. The real value is an AI managing complex on-chain financial settlements in real time. It's the analytical brain of the AI directing the secure, instant nervous system of the blockchain to move capital efficiently, securely, and without those slow human bottlenecks.
So, what does this all mean for you listening right now in this current macro environment? Let's bring it back to where we started. Retail is terrified. The fear index is at a 10. Yet, right in the middle of all this panic, Bitcoin just rallied from $63,000 to $73,000, while the index stayed glued to extreme fear. It's a classic divergence. The crowd is paralyzed, but the asset is quietly climbing.
Historically, though, crypto has often been treated as a high-beta tech stock. It usually crashes alongside traditional equities during global macro crises. I'm curious about the data and the reports regarding the recent Iran geopolitical crisis. How did the market behave?
I want to be very clear that we are impartially reporting the market data provided in our sources here. We are just looking at the numbers without taking any political stance on the conflict. But purely from a market perspective, for the first time during a real major geopolitical event, Bitcoin acted as a true safe haven asset.
Really?
Yeah. While global markets were reacting to the uncertainty, Bitcoin actually outperformed equities. It outperformed gold, silver, and platinum.
That is the ultimate takeaway for you listening today. Every single market cycle has the exact same psychological pattern. Accumulation happens in extreme fear, and distribution happens in extreme euphoria. We are in extreme fear. But whales aren't just buying ETH and moving it to cold storage. They are signaling that the next macro move is up.
They're looking past the current crisis.
Precisely. The massive institutional infrastructure being built right now by the Qivalis consortium of European banks, by the DTCC integration, by the tokenization of billions in treasury assets, it isn't being built for a quick trade today. It is being built for the next massive wave of adoption. They are building the rails for the 2027 and 2028 cycle. If you only watch the daily price tickers, you are completely missing the real story. You have to watch the wallets and you have to watch where the infrastructure is being laid.
The smart money is playing a completely different game on a much longer timeline.
Think about this to wrap things up. If the DTCC successfully tokenizes millions of traditional securities on the blockchain to settle instantly, and AI systems become the primary real-time underwriters for complex financial risk, what happens to the traditional stockbroker or the neighborhood loan officer in 5 years? Will your next mortgage be completely underwritten by an AI and settled on the Ethereum blockchain in 3 seconds? The technology isn't science fiction anymore, and the banks are already laying the tracks.
If this deep dive gave you a different perspective on what's happening beneath the surface, hit subscribe. We break down what the headlines miss, the on-chain reality, the institutional moves, the smart money positioning. AIA Uncut. See you next episode.